Um, I'll call the meeting to order. And the first item on the agenda is to hear, consider, and approve the minutes of March 24th, 2021. I will start off by making.
Tom, just 1 second, because I can't see everybody who's on. Is Walter Burke on? Jack Mahoney, are you on? Yep.
Yes, I am.
Jack Mahoney's on.
Yes.
Bruce Ryan, are you on? Nope. I see you now, Tom. Okay, thank you. Go
All
ahead,
right.
Tom.
Yeah, no problem. I just want to make an amendment to those meeting minutes.
Yeah, I got your correction, Tom.
Okay.
I will put that in.
All right. I'll just read it briefly for everyone. The minute, I think it was a bit of an over summary. The phrase "Tom McCarthy agreed to sound economic decisions." I would expand that and replace that language with the following: while expressing reservations about inserting ESG language into the investment policy guidelines, Tom McCarthy stated that he would become comfortable with the language provided there was clear understanding that political agendas would never supersede sound economics when it comes to decision affecting the retirement fund. So I believe that captures what was said in the meeting on the 24th. So do I have a motion to accept the meeting minutes as amended? Or are there any other amendments?
I'll make a motion to accept the minutes.
As
No,
amended.
second.
Great. All in favor?
I'm sorry, who seconded?
Jack.
Who seconded? Jack made a
Jared.
motion. Who seconded?
Jared.
Thank you.
All in favor?
Aye.
Aye.
Unanimous.
No, Russ Atkins is going to abstain. I wasn't there last month. Sorry.
And Eric Caliper, I'm going to abstain also. I wasn't there last month either.
All right then. Well, the next item on the agenda is alternate assets review with presentations from current managers. And I think I heard one of our managers is here already.
Yep, you have Mark Andrew from Lexington Partners.
All right then. If you have no objections, could you kick it off?
Absolutely, absolutely. And I'm going to kick it off by saying I'm not looking for any sympathy, but I had my second vaccine shot yesterday, so I've had a bit of a chills and fatigue, but I'm still going to try to bring a little bit of energy to you. So apologies for that.
If you collapse forward into your laptop, we know what happened.
Yeah, I should be okay. I should be okay. So I'm assuming everyone has a presentation in front of them, Brian, and I can just kind of skip through pages, and I'm not planning on going through every page. I know I have somewhere between 15 and 20 minutes, so I figured I'd just give a reminder to everybody about what Lexington Partners does, a little update on our firm, talk about our market, and then get to what you really care about, which is the performance of the investments that Town of Fairfield has made with us. So I'll start that by kicking off on page 3. Here is, again, the headline here is, we are a secondary market leader. We are one of the pioneers in the secondary market, founded in 1994. And essentially what we're doing is we're buying existing private equity funds that are typically already 4 to 5 to 6 years old. And we're typically buying them at a discount to value. And then we become a replacement limited partner in those funds. And then we hold them really for the rest of the life of those funds. And what I would say about our team, our market experience, and our performance is, I think you'll see a lot of consistency throughout all of those, each of those bullet points on the side. So our partners, we've been working together for over 18 years on average. We've been through a lot of investment cycles together, and we have grown tremendously. You'll see our size of our market has grown. You'll see the size of our funds has grown. But our team now is 133 employees. we have offices, 8 offices across the globe, and we're in all the major private equity centers in those countries. And we're very proud of the fact that we have over 1,000 investors in 40 different countries, some of the most sophisticated investors around the world. And then our extensive market experience, again, there's a lot of numbers here, but what I would just say, we've done 550 secondary transactions. Number one, there's a seller on every side of that transaction. I'll talk a little bit about what the profile of the sellers is later on, but there's a seller on the other side of every one of those transactions. We have a reputation of doing what we say we're going to do, and there's many sellers that we're buying from on multiple occasions over time. And then the other number I would look at in that middle bar is that 800 sponsor relationships. Again, for us to be able to analyze these portfolios, we need to be able to pick up the phone and call these GPs and these sponsors and get an update from them on their portfolio companies and really drill down. So if you don't have those sponsor relationships, it's really hard for anyone to do any significant due diligence on the portfolios that may be for sale. So that's an important characterization for us. And then finally, again, like I said, what you care about most is our secondary performance. And over a long period of time, we've generated net to our LPs of north of 16% IRR and a multiple of 1.5 times. And I will tell you that multiple is understated, in my opinion, because our largest funds are still young and maturing, and we expect those to ultimately deliver kind of 1.6 to 1.7 times. And I'll talk about specific performance for Town of Fairfield. And then the last point on this, as you can see in the red, we have outperformed the S&P 500 by 740 basis points since inception. On the next page, just on here's just a quick picture of kind of where our offices are. I'm actually a partner in our Boston office. The main operations for our firm is in New York. All of our back shop, our accounting professionals, investor relationship, that's all done out of New York. We have a team in Menlo Park really focused on venture funds, with only firm with an office on Sand Hill Road out in Menlo Park. And then you can see all the other key geographies. I'd say London's a key geography for us, Hong Kong, and are kind of where most of our investors and our selling activity has come from a lot of these offices. And then page 5, this just shows you kind of our investment committee, and you can see the experience. We've all been investing together for a long period of time. Again, like I said, over a bunch of different investment cycles. And more importantly, forgetting about our partners, I also look down to the next tier of our leadership going forward, I think, is our principals and vice presidents. Even our principals have been there for over 10 years. So we've had very little turnover, and we've grown most of our talent internally. And then page 6, this just shows you a bit of our capitalization, and I'm going to focus you really on the left-hand side of this chart. That's really our secondary platform. And the piece that Town of Fairfield invests in is our middle market secondary strategy. So if you look at that, our last fund, Lexington Middle Market 4, was a 2.6 to almost $2.7 billion fund that we raised in 2017. You compare that with our global strategy. Our global strategy, we expect the last fund was close to 14 billion. We expect our next fund to be 15 billion, but it's a much larger strategy. It covers the globe. It covers venture, growth, buyout, energy, infrastructure, all kinds of private equity alternatives are in our global strategy. Our middle market is really focused on pure middle market funds, mostly in the U.S. I'd say 85 to 90% are going to be in the U.S. and we have a small allocation to do some middle market funds in Europe as well. So, and that's where the focus of this presentation really is going to be for the rest of the time, just because that's where, to give you for an example, Lexington Middle Market Investors 2, which was closed in 2009, Town of Fairfield committed $5 million to that. Lexington Middle Market 3, Town of Fairfield committed $10 million, and then Lexington Middle Market Investors 4, Town of Fairfield committed $3 million, and we'll get into the performance numbers. And with that, I was going to just jump quickly to page 10, and I would just kind of try to get your eyes to go more to the bottom part of this chart. and that is the sizing of our secondary market transactions over our history. So you can see again, when I started doing this, it was before 2002, but in 2002, this was kind of a $2 billion market in the secondary. That grew in 2019 up to 84 billion. And we think over the near term, it's going to remain in that kind of 85 to over $100 billion annual market. And I'll talk a little bit of why we think that's the case. 2020, you see it go down to 57 billion. That's because really very little was getting done during the first half of last year because of the pandemic. But that, the bulk of that happened in the second half of last year. So, and we think, again, like I said, we will be north of 85 billion most likely in 2021. And the reason for that growth really now leads you to the top chart. So that top chart shows you how much is raised in the primary private equity market. And again, I said earlier that we're looking back things that are kind of 4 or 5 years old. So as we're investing our capital over the next 4 to 5 years, we're looking back all the way to the 2014 period, and in many cases even before that. But we've kind of put that box around 2014 to 2020 because that's really our inventory going forward. So you can see in the primary market, 4.3 trillion was raised in that market. So the next important stat, how we look at sizing the market, really is on the next page, on page 11, is so how much of that over the life of the fund, how much of that fund will turn over? And so I'll pick on, 2010, any funds that were raised in 2010, about 10% of that fund turned over. And that number has, increased, over time. Again, when I go way back in time, the weighted average was probably 5% of the things turned over. But now, as these things mature, they have generally traded at north of 10%. And that is what we expect will happen as the 2013, 14, 15 funds start to mature. We expect that turnover will be, closer to that 10% level. And that's kind of how we size the market. And that's what's shown in that box below, that annual average, I said, 89 to $107 billion in the secondary market. So that's a little bit on our market. I think with that, I was going to really turn and focus more on our middle market strategy, which jumps you forward to page 19. And give you a little sense. Number one, these are some of the deals that we were involved with for our middle market strategy over the past several years. Just to give you a sense, some of the sellers you can see, U.S. public pensions, U.S. endowment, those type of sellers. Again, keep in mind, none of those sellers were reducing their private equity allocation. Many of them were just trying to sell some older portfolios so they could use the proceeds from those sales to recommit more dollars going forward because they were bumping up against an allocation. So there are several reasons why folks sell, but that's generally why some of these folks have been selling their private equity interest, and they actively manage their portfolios to kind of manage to their allocation level. But none of them are really reducing their private equity allocation. And then with that, I'll just show you a little bit, this on page 20, this just shows you a little bit of the difference between our middle market strategy and our global strategy. I referenced it before. Again, 85% of this is mid-market, small mid-market buyout. There's another 16% of growth versus our global funds down below. You can see much more diversified across different types of sectors, including venture, infrastructure, and energy. And then from a geography standpoint, mostly U.S. Versus our global strategy is, close to a third of it is non-U.S. And then when we're buying these funds, the middle market strategy is a little younger. So we're acquiring a little bit more unfunded in our middle market strategy than our global strategy. They're more mature funds. And because of that, we really have a laser focus on the quality of the managers that we're investing in our middle market strategy. And that's what's really shown on page 21. Try to give you an idea. I know up here in Boston, Abry Partners and Berkshire Partners are some of the top private equity sponsors in their sectors. I have a 30-plus year relationship with the folks at the Jordan Company. They were the founder there, Jay Jordan, was one of the early pioneers in the buyout. So these are all highly respected middle market managers in the U.S. And then with that, I thought I would just go to page 23, which shows you kind of the performance numbers. And again, but the takeaway, and I'm going to point you really to the red numbers down below for LMMI, and I'm going to focus on funds 2, 3, and 4. So the net multiple in Fund 2 for Town of Fairfield is 1.8 times, with a net IRR of close to 15%. Again, that's an older fund. Those returns are pretty, I don't think they're going to get much better than they are, but that is a very, very good performing fund in the secondary space. LMMI 3, there's still 630 million of reported value left in that fund. So we do think there's continued appreciation here. It's a younger profile, raised in 2013. So I would expect here that 1.5 eventually is going to move up to close to 1.7 times would be my estimate, with a net IRR of 16.6%. And then 4, it's really young in 4. It stands at 1.2 times, but I'll talk about some of the quality in there. But our expectation is that this will also deliver, again, it's early, but we think this will also deliver something north of 1.7 times for the Town of Fairfield, with a high IRR there, north of 21% for that fund. And then I'll jump over the next slide and really get into kind of what you care about. And then rather than go through every number in that box for you, I thought maybe if I just kind of gave you some highlights from Town of Fairfield, that's kind of at a fund level. If I gave you some highlights for Town of Fairfield, in Lexington Middle Market 2, I mentioned $5 million commitment. You've contributed just under 4.9 million towards that commitment. We've distributed back to you 7.3 million, and there is remaining value of 1.3 million left for you. So that's what you get to your 1.8 times and 15% net IRR for LMMI 2 for the Town of Fairfield. And then just jumping back in the presentation, this is just where is that remaining exposure I talked about, and those are some of the firms where our exposure is concentrated. Again, Metalmark, it was the former Morgan Stanley Capital Partners. We've got a 30-year history with them. TA Associates is probably the top growth manager in private equity, and they're based here in Boston and also out in Menlo Park. So we feel really good about the remaining exposure here, but there's only 173 million left in this fund. So the bulk of this has been already realized. So I'll jump on to LMMI 3 and do kind of the same thing for Town of Fairfield. It was a 10 million commitment. You've contributed 8.2 million towards that commitment. You've received back about 7.4 million, and you have remaining value left here of 5 million. So still significant value left in LMMI 3, but we sit right now at a little north of 1.5 times net for the Town of Fairfield and a 16% net IRR. So again, another very good performing fund. Some of the same names you'll see here. Again, Metalmark, TA Associates, Summit Partners, all really highly respected funds. So we expect there's a lot of value left in this, and that we will get that return up to 1.7 times. And then just on 28, this just gives you an idea of the consistency of the distributions over time. You can see that we have distributed, and basically, if you look at your records, we're distributing basically at least every quarter since the final close. And last year was another good distribution year. And then LMMI 4, I kind of just wrap up on LMMI 4 and just again do the same numbers for Town of Fairfield. Commitment here was reduced to $3 million. You've contributed 1.2 million. You've received back distributions of 153,000 at this point, but there's a remaining value of 1.3 million to kind of get you to the 1.2 times. And the other thing I should reference, particularly at LMMI 3 and 4, where there's significant value. If you look in that box for LMMI 4, where it says RV, we're usually a quarter lag behind the actual GP value. So those valuations that I'm giving you and those returns I'm giving you are based off of 9/30 GP values. And I will tell you for the fourth quarter, we have almost all of them reporting. Those numbers are going to be up 14% for the fourth quarter. So we had a really good bounce back in the fourth quarter. We expect the first quarter will be another increase. So when you see your numbers for when the audited numbers come out, I think that 1.2 times is going to be closer to 1.3 times. But like I said, it's a young portfolio. It's still a lot of value left to get out of it, but we feel really good about the quality. And in terms of quality, I think you can see that a couple slides forward on page 32. Those are kind of the main exposures, those top 10 exposures. I've talked about some of them. One Equity Partners was a spin out from JP Morgan. Dick Cashin heads up that firm, a long-term successful private equity investor. And I referenced Berkshire and Abry and the Jordan Company, along with Summit Partners. So we feel really good about the exposure we have here and expect continued increases in value. So hopefully, again, this will get somewhere in that 1.7 to 1.8 range. So across all three of your investments, I think you're going to end up in that 1.7 to 1.8. We pride ourselves on delivering consistent returns, and I think that's what we've done for you guys. So, and I just finished by saying, as a finance guy, there's sometimes you don't really realize if you're doing any good, but it's actually meetings like this where we know providing returns for folks for their pension who are, many of them are, first responders, and being able to deliver good results for protecting their pension is important to us. And we don't lose sight of that fact. So we hope this performance will continue to be very strong and solid for you guys. And with that, I would just open it up to any questions that you may have.
Hey, Mark, quickly, just so I think I understand what that net multiple represents, but what are the variables in that calculation?
Yeah, that's really the difference between the gross and the net would be fees paid to us, fees paid to the firm, and the carry in the profit sharing we get. So we get somewhere between a 10 and a 12.5% carry on the profits after we've returned 100% of capital, including fees, back to the investors. But that's why you have the delta in the multiple.
Okay.
And it's in similar. The IRR is a very similar impact.
How would you describe like middle market, right? What size of a company? I know they're private companies, but what like?
I'd say it runs the game. It's a pretty wide gamut, and I would say, for example, a lot of times we look at fund size, but I mentioned Berkshire Partners. They have like $7 billion funds, but their DNA is still investing in middle market companies. So I would say it's anywhere from 25 million to EBITDA to something 100 million of EBITDA is kind of what these folks are investing in. But it is a wide range. It's mostly our history with those firms that's where they have done historically has been in the U.S. middle market.
And just to jump on Eric's question a little bit, would you hold the same asset across multiple funds, the same private company? Is that possible, that there's exposure to the same company?
It is possible. So, if I go back maybe to one of the slides that has kind of a
Sorry,
go back to the slide on
sharing.
page 20. Yeah. If I go back on page 20, there's kind of the middle market funds up top and then the global funds down the bottom. And so you see there is a chunk of blue in that global strategy, which is small and mid-market buyout. So sometimes that will, there will be an allocation to both funds on a certain transaction. And I'll use an example that we try to manage concentration within our funds. So we may have a large deal that we're doing for a middle market transaction, but we think by putting all of it in our middle market strategy, it makes that fund too concentrated. So we'll take a piece of that and put it into our global fund. And that's how we try to manage both concentration risk, maybe GP exposure. We don't want one GP making up too much of one of our funds. So we manage that allocation. But if it's a middle market fund And it used to be a bright line, like if it's less than 50% funded, 100% of that will go to the middle market fund up to kind of our comfort with the exposure. But yeah, there are fund exposures across both of these strategies that are the same.
Thanks a lot, Mark.
Yep.
I don't know if there's any other questions, but we also had our next partner dial in.
Okay. All right. Well, thank you, everyone.
Thanks, Brian.
Maybe next year I'll see you in person.
Thanks again, Mark.
Thanks, Brian.
Thank you, Mark.
Thank
Feel
you.
better.
Thank you.
Hi, Courtney.
Hi, Brian. It's nice to be with you all today. Hello to everyone from town of Fairfield.
Hey, everyone. Have Courtney Hayes and her partner. It's from Mesero. So just give me a moment, and I could bring up your presentation, Courtney.
Wonderful.
helps you?
That
Okay,
would be
give me
great.
one moment.
Thank you. Thank you.
As I'm doing that, is there a certain place you want me to go to?
Why don't we start, if you just flip a couple slides in, let's go to slide 4 and we'll just begin there.
Someone give me a thumbs up, or if you all can see it, good. All
We
right,
can
good.
see that. That's great. Thanks, Brian.
Thanks.
And thank you for inviting Mark and I to present today. We're delighted to have the opportunity. To everyone at Town of Fairfield, thank you for having us. I know some of you are familiar with Mesero Private Equity. I also understand there may be some new board members. So just very quickly, I'm Courtney Haynes. I am responsible for investor and consultant relations at Mesero Private Equity. And Mark Sachs is here. He's the CEO and head of our private equity business. Mark will be giving you a detailed dive into your commitments to Fund 6 and Fund 7A. And I'm just going to start off here on slide 4, really as a reminder of who Mesero is, and just really wanted to thank you for your commitment and your support. So Mesero, we are headquartered in Chicago. We are an independent employee-owned financial services firm. Most of our clients who are global institutional investors look to us as a premier provider of alternative asset solutions. At the firm level, we have about 40 billion in AUM. Mark is on the board of directors, but for all intents and purposes, our goal is working in private equity. We have twin mission goals, which are to generate outperformance for our investors, as well as to deliver outstanding client service. Ryan, if you wouldn't mind advancing one slide. Mesero Private Equity, thank you. These are some of our competitive advantages or ways in which we're differentiated. We've raised about $7 billion in commitments since inception to our strategies. Those include our commingled fund of funds, our commingled co-investment funds, and a handful of custom accounts. You all have exposure to us through Fund 6 and Fund 7A, which are two of our more recent fund of funds, a 2013 vintage year fund of fund and a 2017 vintage year fund of fund. One of the hallmarks of our strategy is that we have we've really been intentional in terms of raising assets. So we are highly selective in terms of our portfolio construction, meaning that every year we're committing to only about 8 to 12 funds per year. I think it's an important distinction to make as it relates to our strategy. There are hundreds, 300 institutional quality funds and managers raising capital every year by selecting only the very best managers and providing diversified exposure for our clients. That's how we've generated the outperformance that we're going to show you in a couple of slides. We could flip to one more slide, please. This is our team. I think of us as having 3 legs to the stool. So Mark Sachs is obviously the leader of our team, our CEO. He heads up our investment team on the upper left-hand side of this slide. His partner is Tom Galoon, and along with the two of them, Bob DeBolt, Ryan Fedronich, and Christina Pierce make up our 5-person private equity investment committee. You can see the depth and breadth of experience here on the investment team, senior leadership, all the way down to analyst level. Again, I mentioned I'm responsible for investor and consultant relations. So my role is really to be a resource to you and to your partners. Matt Cohen heads up our accounting team. And then all the people that are shaded in gray here are representatives of Mesirow, and we leverage their expertise in the way of legal, compliance, IT, HR, accounting, all of those ancillary services that allow us to focus day in and day out on private equity. If we could flip to the next slide, I just wanted to give you a quick glimpse into our client base. We're really proud of the investors that we serve. Almost 50% of our AUM are from public pension plans, almost 30% are from multi-employer pension plans, and the remainder are endowments, foundations, insurance companies, and other institutional investors. And almost 90% of our assets are from clients in the US. So we're proud to have Town of Fairfield as an investor, and we think that you are among good company. We work with many of the consultants in this industry, and we're really delighted to be here today with you all. So I'm just going to thank you again for your support, and I'll turn it to Mark on slide 9 to pick up with a detailed review of your portfolio.
Thanks, Courtney, and good evening, everyone. Thank you so much for giving Courtney and I the opportunity to give you an update on the portfolio. You know, I was looking through my notes. I actually was out there in Fairfield to present to your board about 9 years ago, actually. It was the first half. It was the summer of 2012, because you committed $15 million, and it closed on August 13th of 2012, and the fund, you know, began inception and so forth in 2013. And I remember it well because I grew up in New York and worked actually for IBM Pension in Stamford for several years before moving to Chicago in the early 90s. So it was sort of like coming back home to visit with you. We had a home in the Westport area, and it was great to see you. So I just want to say, first of all, thank you for your commitment then, and thanks for the follow-on commitment to 7A in 2017. So I'm going to start with a scorecard to show you how we've done, and I must tell you that we're delighted with the performance. We're very happy, and we hope you will be too. We hope you are. So just to recap, back in 2012, you did commit $15 million to our 6th private equity partnership fund. We did draw capital in 2013. That was the inception point of the fund. And at this point, the fund is fully committed, is almost fully drawn. And for some time now, we have not drawn down capital from you. We've actually funded the capital calls out of distributions, which is really the strategy. Generally, the last third or so of capital draws come not from additional commitments from the investors, but from distributions. And that's been the case here. Fund 6 is an excellent fund, generating a almost now an 8-year net annual IRR of 22%, a deep first quartile, and a net multiple of over 2 times. I'll go through, you know, the detail in a moment, but I just want to make the point that I'm sure this is more than I even told you we hoped we could do. We've actually done, we are accomplishing the same thing with the follow-on fund, Fund 7A. It's very difficult to build a portfolio of 35 funds and 900 or 1,000 companies and generate sort of more than 2 times your money and kind of 20 sort of net IRR. But we've been able to do that, and we're pleased, and I'm going to tell you a little bit about how we've been able to do that. That commitment was followed in 2017 with a $4 million commitment to our next private equity fund, to Fund 7A. That is a little more than half drawn. It is fully committed at this point, but not fully drawn. There's been some early liquidity, which has really, really jumped us out of the J curve, and we're generating a little better than a 21% net return, which is also excellent, particularly given the fund-to-fund format, the broad diversification. I'm reminding the board that although the the TVPI or the multiple is only 1.3 times. That's because it's a very young fund, and we have every reason to believe that, 3-4 years from now, when Fund 7A is the same age as Fund 6, we're hoping to generate at least a 2 times net multiple. So in total, then you've committed $19 million. We've drawn 15 million against that. We've distributed about $5 million. There's almost $25 million in remaining value. And the total net IRR for your program with Mesirow Private Equity is a very sporty 22% net IRR and a 2 times multiple. So, and again, just to remind you, 6 has still got some value and will continue to build, but 7A is quite young, and we're expecting, significant value creation in both funds. Let's keep going, please. So this is just a reminder of the strategy, and then we'll talk quickly about a few of the most important performance drivers. Both Fund 6 and 7A and our new fund of Fund 8A are designed to construct a diversified portfolio of what we believe to be the best private equity and venture capital funds coming back to market over a 3 to 4 year commitment or vintage year period. You can see that the strategy is heavily oriented towards buyouts and growth. This is meant to be a conservative portfolio of mostly cash flow positive or almost cash flow positive growing companies where there's an opportunity to improve operating performance and really generate excellent returns. About 10% of the funds have been invested in early stage technology venture capital with what we think are the best venture firms in the world, and that has really added a lot of value. Portfolio is principally invested in companies in the United States, about 20% in Western Europe, and a very small sliver in the emerging markets. And both these funds have committed virtually all their capital to primary funds, but as you'll see, somewhere between 5 and 10% has been used to purchase secondaries, which really has helped drive early performance and helped us get out of the J curve more quickly. So it's meant to provide diversification by subclass, by manager, and really give you full market coverage of the best private equity strategies over each fund's commitment period. Next slide, please. So we wanted to just share with the board a longer scorecard. You are invested in funds 5 and 6, which you can see is our 09 and our 2013 fund. But I just wanted to share with you the last 20 years of performance. The performance has been consistently good, but you really joined the program with us as our performance was really being perfected. And in fact, you're in our 2 most recent mature funds, which are not only the best performers on an absolute basis, but are generating the largest dispersion in performance against the benchmark, which is the Cambridge median benchmark. So we're very, very happy with the IRR and the accelerating IRR across all of our funds. And again, reminding you, you're in Fund 6 and 7. On the right side of the page, we know that you don't pay your beneficiaries with IRR, you pay them with dollars. So we also build these portfolios for power, meaning we're trying to generate excellent IRRs, but also deliver to you and our other investors at least a 2 times net multiple on invested capital, which is very hard to do in a very broadly diversified portfolio. We've done it by accessing really only the very best managers, by overweighting in each of our fund of funds 4 or 5 or 6 that we think are the very best. And frankly, each of the ones that we've overweighted have been the best performers. That's good when it works that way. And finally, we never lose money. You can look at the top bullet and see that our loss rates across 20 years in investing, over $5 billion of capital in funds, our loss rates are below 1%. So I think that comes from the experience, and you can see how our performance has gotten better and better over time. Next slide, please. All right, this is a snapshot of Fund 6. Again, a $658 million fund formed in 2013. Town of Fairfield had a $15 million commitment. This tracks what I shared with you earlier. You're generating, or we're generating on your behalf, about a 7-year almost an 8-year IRR of 22%, a multiple on your money, so-called total value to paid-in capital of over 2.1 times. You can see most of the capital was deployed in 2014, 15, and 16, and a little bit in 2017 and 18. I'm going to cover 3 of the key alpha drivers or performance drivers, but you can look through the portfolio. These are, in our view, the best private equity and venture firms that came to market during the commitment period of Mesirow Fund 6. Next slide. So just to give the board a flavor of what's inside our fund-to-fund, here are 3 of the performers in very different spaces. On the left is Meritech. Meritech is a Palo Alto-based late-stage venture capital fund. They're one of the best venture firms in the industry, early stage or late stage. We've been investing with them for many years. This partnership fund, Fund 6, invested $17.2 million in Meritech Fund 5. Now look at my notes that you don't have and share the detail. This is a 2014 venture capital fund, Meritech Capital Partners 5, and at December, it was generating 5.6 times net multiple on invested capital and a 51% net IRR. This is one of the best venture capital funds formed, if probably one of the top decile funds formed in 2014, and we're delighted that you have exposure to it. Some of the enormous value drivers here include Roblox, which is an online gaming platform, which is now public and has generated over 40 times capital, and Datadog, which is an IT infrastructure company, which has generated 30 times. So Meritech is an important driver of performance for Fund 6, and again, is a late-stage U.S.-based venture capital fund. In the center, just for something completely different, Advent International Fund 8 is a 2016 fund. We invested $30 million out of our partnership Fund 6 in that fund. Advent is one of the oldest, most experienced private equity buyout firms on the continent. They focus on Western Europe. This fund is generating a 27.4% net IRR and a 2 times net multiple. And then on the right is probably my favorite growth equity firm in our portfolio. It's a Boston-based firm, not too far from you, called Spectrum, a spectacular firm. It seems like everything they touch turns to gold. This firm is generating a 47% net IRR. It's about a 7.5-year-old fund, 4.2 times multiple. You may recognize some of the marquee companies, including Ancestry.com, which generated 3 times capital, and GoodRx. GoodRx, I hope everyone has GoodRx on their phone. You go to a pharmacy, you need to buy a prescription, you get a deep discount. And this company has generated 40 times capital since the IPO in September of last year. So a lot of power, a lot of value, and a lot of diversity in your portfolio. And I just wanted to share a little detail. So that's Fund 6, and we're delighted, obviously. Next is 7A. That was our successor fund of funds that Fairfield participated in. 2017 fund, also around $650 million, fully committed but a younger fund, 57% drawn. It's already begun to develop and generate, strong value. We believe the rest of the capital will be drawn over the next probably 3 years. But once we get to about 70% drawn, which will probably be in the next 12 months, we will no longer likely draw capital from you. We'll fund the last third or so out of distributions. Okay, funds 7A, same strategy, investing alongside or in the best funds in the market. It's generating a net IRR of 21.2%, a 1.3 multiple. I'd be very surprised if this also did not hit a 2 times net multiple for you over the next 5 years as the investments mature and develop. So let me share with you 3 of the key drivers here. Next slide. Our favorite mid-cap software buyout firm is Thoma Bravo, based in San Francisco. Surely the best software investor in the world, without any doubt. We do love Thoma Bravo. And Fund 7A invested $4 million in their flagship fund. Again, these are relatively new funds, so performance is just developing. That was 2.5 years ago. Meritech, we just talked about Meritech. This is their next fund, Meritech Fund 6. Again, they're doing late stage venture. And Silversmith, which is a new relationship for us, doing growth, equity, and non-control buyout and growth investing. We invested $20 million about 3 years ago. All 3 of these funds are doing great. Let me share with you the latest performance numbers. Give me a moment. Thoma Bravo has had some enormous early wins, including Ellie Mae, which is a mortgage software company, which was sold after about 1.5 years for 4 times capital. So at December, the Thoma Bravo fund investment is generating a 71% net IRR. Again, it's only been 3 years, but that's excellent. It's generating 1.8 times capital, and this portfolio is rocking it. I can't imagine this won't generate at least a 3 times multiple. So that's Thoma Bravo. Meritech is generating a 52.5% net IRR and a 1.2 times multiple, driven by some of their early late stage investments, including Snowflake, Bright Health, and UiPath. And then on the right is Silversmith, generating a 40% net IRR and a 1.6 times multiple. So just a little flavor of the terrific private equity funds we provided access for you through our fund of fund. I just want to quickly share with the board on the next slide that we are out in the market with our successor fund, Fund 8, maybe one more slide, if you will. The strategy really is very, very similar. It's frankly, we're replicating the strategy that you're familiar with in 6 and 7. This is a $500 million target. We've already raised we've actually raised about $465 million. This fund has already begun investing. It's about 1 year into its investment cycle. We expect this fund will be open through the end of this year, and again will be around $600 or $700 million. We're very excited about the managers we've put into this fund already. The only change in the strategy to share with you is that, frankly, based on popular demand, we've added a co-investment sleeve. So 15% of the capital from 8A will go into co-investments, about 10% into secondaries, and then 75% into primaries. We certainly would welcome your participation. We'd love to keep working with you. And we think that this will also be, another excellent fund of fund. I think I'm going to stop. Courtney, is there anything else we should cover before we ask for questions?
No, that's what we've prepared, but we're happy to answer any questions, as Mark said.
Thank you.
Guys, hi. May I ask a question? This is Carolyn Trabuco calling from the phone. Sorry. One of the issues we wrestle with is that two of our funds are closed to new participants, our pension funds, and are forecasted to kind of run out, if you will, within the next 20 years. And I'm thinking about your first comment of your first time coming to present to Fairfield was 9 years ago.
Right.
And I'm just wondering if you can give us a sense of perspective. I mean, at this point, you know, if you're thinking about Fund 8, you know, are we effectively on an off time for you because, you know, our funds are closed, and, you know, 15 years from now or so, they're going to be quite a bit smaller.
Courtney, do you want to take that one?
Sure. And so I just want to make sure I understand your point of view. So with our Fund 6, that's a 2013 vintage year fund. Fund 7A is a 2017 vintage year fund. These funds have a commitment period of about 4 years. And that's during that time period is when we are committing capital to managers, as you probably well know. Those managers underlying our commitments are investing over about the same time horizon. So an additional 4-year or so commitment period. We're then working with those managers to have exits and realizations and send distributions back to you, which does extend the time of these funds. Both of the funds have a 12-year term with 3 one-year extension periods. So essentially, when you're looking at a private equity fund to fund, it's pretty typical to think of a 15-year life. Then at the end of the 15 years, there may still be significant NAV residual value that we're trying to maximize. So we take you through kind of an orderly process as we wind down and send capital back to our investors. We usually at that point in time will consider a secondary sale of our fund to a secondary buyer. And there's many firms that do this. We just recently completed secondary sales for our Fund 1 and Fund 2, which are much older funds.
Right.
And we're able to send that final distributions back and close those off your books. Does that help?
So
Go
if I
ahead.
understood the question also, I think you were wondering if your funds that are running off should be committing to such a long-lived closed-end private equity fund. I think that's also part of your question. Is that right?
Yeah, that's exactly.
So let me
what we're
add, I
thinking.
think Courtney answered the fund of fund. If you go to the next slide, so the next slide is our direct co-investment fund. As I mentioned, 15% of the fund of fund is downloaded into the direct. The direct fund is a shorter lived fund. Instead, it's actually going to invest all of its capital in 4 or 5 years. So instead of having maybe a 15-year life, is probably likely to have maybe a 10 or 11-year life because the capital goes out much more quickly and comes back more quickly. But we just want to be completely transparent that the fund of funds in particular, most of the capital will come back at the end of 10 or 12 years, but they're these long tails. We don't want to sell our fund to a secondary buyer when we think there's a lot of value left. We'd rather sell it to a secondary buyer when, there's kind of no value left, which is what you want us to do, which is why, the sale that we've made, Fund 2 was an 01 fund and we only sold it like last year. So I would say that if you've got a 15-year life, if anything, I would say you should consider the fund we're looking at on the screen now, which is our shorter hold fund. But these private equity funds are long dated vehicles, and you need to have patience. You want to have patience to allow the funds to fully build value, harvest, and liquidate without being kind of forced to sell after 10 years or 12 years to a secondary buyer, because as you would guess, secondary buyers, including us, want to buy at a discount to value.
Thank you. Thanks. Those are great. Thank you for your thoughts on that.
Of course.
Mark, Eric Caliper here. I may be the only trustee that was on the board back in 2012 when.
Nice to see you again, Eric.
Thank you for
I'll
having
tell
me.
you what I remember, a quick story. So we got the invitation and it said, you're on at 8:30. I said, well, I'm going to have to fly in from Chicago the night before if we're on at 8:30 in the morning. And your consultant at the time, I don't remember who it was, said, I don't think you understand. This is a working board. It's 8:30 at night. And we actually didn't go on, Eric, until 9:15 that night. So it was a unique experience, but it was great, and we were delighted to work with you. But I do remember that was very funny. I thought it was the morning.
You've done great for us, and I just have one question about diligence. So, explain to me how you'll work with a PE fund specifically and look at their books and see how they're marketing their assets. Can you explain that diligence process?
Right. It's a great question. So a private equity fund, including all of the funds that we invest in and any funds you would invest in, are blind pools when they're formed, unless it's a secondary. But let's put that off to the side, which is a partially or fully funded portfolio. But any primary fund that's being newly formed, the portfolio is empty when it starts, and you don't know, and the general partners don't know what specific companies they're going to invest in over the next 5 years. So the only way to evaluate a track record is to look backwards. So and normally let's say we're looking at Thoma Bravo Fund 12. You really have to go back to Thoma Bravo Fund 10 and 11, which were raised 5-6 years ago, to get a sense of companies that have had a chance to mature and to grow. So now to answer your question, one of the reasons you don't want to invest in a first-time fund or a first-time group of investors, which is even worse, is because the only way we can get comfortable that a manager has the skill and the ability to source attractive investments, improve operating performance, which is the best way to create value and to make money, to generate returns, and to be able to exit and generate great performance, is to look at what they have done in the past. So we look literally at if a manager is raising Fund 3 or Fund 8 or Fund 12, we go all the way back, in some cases 15 years, to 5 prior funds, and literally look, the realized deals are the realized deals, but we want to understand how they created value. So I'll just try and do this quick. There's 2 things to look at: realized and unrealized. On the realized, they want to tell you, look, Mark, look, Eric, we took $1, we turned it into $3. You should just be happy now. Go home and leave us alone. And the truth is that there are 3 ways to make money in the buyout business. You can buy a company at 8 times capital and sell it for 14 times. That's called multiple expansion. You have no control over that, but it's good when it happens. The second way is you finance a company when interest rates are high, and then interest rates drop, and you get the benefit of refinancing at low rates. Well, that's also nice, but it can go the other way and hurt you. The only skill in our experience that is reliable, repeatable, and bankable is the ability of a manager to improve EBITDA margins, to grow companies, both to make them larger and make them more profitable. So we look carefully at how they've created value. On the unrealized portfolio, and to be honest, that is the art more than the science. That's the single most important thing to look at. All these unrealized companies, and they're unrealized for a good reason. They were done a year ago, 2 years ago, 4 years ago. We don't want to force them to sell, and they don't want to force them to be sold before they're, the wine is ripe. So we literally do a mark to market on every unrealized investment in every portfolio of every investor, every manager we're thinking of investing in. And it won't surprise you to hear that the bad managers, we mark the portfolio down from where these guys were carrying it. And then you put their book in the circular file in the trash can. The best managers, and I'd like to think I do think we invest in the best, we actually find that their carrying values are generally conservative. And that when we do a very, I would say, rough and kind of critical mark to market, we are either validating their unrealized marks, mark to market, or we're actually marking them higher where the general partner is marking it. The other thing we want to know is, what were your most recent unrealized values, looking backwards before you sold a company? And you want to see in 30, 40, 50 cases, which could go back 15, 20 years, that in every case, when they sold a company, it was for the premium, for where they were carrying it. So I'm sorry to give you a long-winded answer, but it takes a lot of work, and it takes a lot of judgment. How, when is the company going to be sold? What is the multiple? What's the margin? What will the debt markets look like? But if you don't do that mark-to-market analysis of the unrealized and sort of deconstruct how they got the realized exits, between interest rates, multiples, and cash flow growth, then you're really sort of just throwing darts in the air. And I think one of the reasons our performance has been consistently strong is number one, I should have said this, we probably review 350 funds a year on your behalf and our other investors. And we pick 8 or 10. So we are saying no, 96% of the time. And we're really looking for that small slice of managers, because the top tier of the private equity managers are the ones who generate virtually all the value. If you take the top, 50 managers, 40 managers in any year, or 30 managers in any year, they're generating virtually all of the alpha of the 200 or 300 who try and raise money. And then so you may ask, well, why are you only investing in 10 instead of 30? Because from the 30 that are all great, we then look at turnover and fund size and terms and strategy and reputation. I also think there's great discipline to the way Mesirow does it. We have large competitors, as you know, and those guys may be committing to 40 or 50 funds a year. I used to work for a firm that was doing that for a dozen years before Mesirow. I think that's a big mistake. I think you want to use your judgment and pick 10 or 8 or 12 of the literally best managers in the world, put them in your portfolio, get exposure to the different industries, and then pick a few of them maybe to overweight. And then you end up with the results that we shared with you today. So I hope that's not too long. And okay, thanks.
Yeah, thanks, Mark and Courtney, for joining us on an evening, but we appreciate it. I think the board's got a lot from this. I know we have one more presenter coming up.
Great.
Great. Well, it was
Thanks
our
for your
pleasure.
time.
Thank you for having us. Hope you all stay well.
Thanks, everybody. Good to see you again. Good seeing you again, Eric.
Thank you.
And principal's on. Hey, Paul.
Good evening, Brian, everybody.
Good. Give me a moment and I can bring up your presentation if you want to just do a quick introduction to the committee.
Yeah, absolutely. So again, good to be with everybody tonight. My name is Paul Stover, and joining me tonight is Brent Heemskirk. I'm a member, for those of you who may have been around for some years, I've been in front of the board in the past in person, so a pleasure to be back in front of you again. So my role is relationship management here at Principal. I've been with the firm in this role for 18 years. Brent is a member of the portfolio management team for the Principal Enhanced Property Fund that we'll be talking through here tonight. He's been with the organization for 10 years and is dedicated solely to the management of this fund, along with the other team members that we'll kind of touch on here in just a moment.
Yeah, thanks, Paul. I know we got started late, so thanks for your patience. We had a bunch of Q&A, but yeah, I'll let you or Brett kick it off.
Very good. Also, I'll just start briefly with some introductory comments and share just maybe a quick overview of the organization. And in the interest of time, I know we'll try and keep it here less than 20 minutes. Maybe I'll just first confirm if that is the timing. Is that still appropriate for everybody tonight?
Yes.
Okay. And we do have there's a lot of slides in the materials that we did share. We do not plan on going through all of those slides, but if you do have questions, if anybody's looked at them in advance, want to take the conversation anywhere, just let us know. We're happy to go there, but we'll be relatively brief in our prepared remarks, hit on a few key points as we go through, but we won't go through all these slides, so no worries there. So just real quick, Principal Real Estate Investors is a part of Principal Global Investors. PGI here at the end of the quarter, we have about $550 billion in assets under management across all major asset classes, including real estate. Close to $90 billion in assets in our real estate organization across all 4 major quadrants of the real estate universe. That includes both public and private real estate, as well as the debt and equity space. And as you can see on the chart on the right-hand side of the screen, one of the key points we'd like to highlight as we have a conversation around our real estate capabilities and what Brent and the team for the Enhanced Property Fund can do. This size and scale is important to the extent that it really brings a lens across the full spectrum of the real estate landscape in the U.S. and globally to what some of the trends are. Really helps guide our research and what the team is doing, how they're positioning the fund for the best results for our investors. So this fund is the Principal Enhanced Property Fund is an open-ended core plus or core plus enhanced focus, open-ended real estate, private equity real estate fund focused on commercial properties in the U.S. only. And so as Brent walks through, he'll go through all the details here, but we're focused on the 4 main property types here in major markets in the U.S: industrial, multifamily, office, and retail, and actively managed fund. So just like any of your actively managed fixed income or equities portfolios, we are actively managing this portfolio, turning over, buying and selling assets, just not at the pace that you would see in a publicly listed securities portfolio, but very much actively managed. And so we'll talk through kind of our outlook and strategy looking ahead, and what we see for keys for success going forward. As far as our relationship, that dates back here with the town of Fairfield almost 9 years here at the beginning of May. So we appreciate very much this longstanding relationship that we've had over those many years, and appreciate again the chance to be in front of you tonight. So I'll pause there and answer any questions that you may have on the organization before we turn to the fund.
If there aren't any, I can
So
jump
Brian,
in.
maybe if you want to move forward a couple of slides, and Brent, I'll turn it over to you. We can kind of recap what the strategy focus is and the team. If anybody has any questions on there's the team. And maybe I will mention, no changes to the organization or the team managing the fund for quite some time. So stability there as well. So
Yeah, just let me know what page you want me to go to and I'll drive for you guys.
okay. Brent, I'll turn it over to you.
Yeah, thanks, Paul. Can everybody hear me okay?
Yes.
Okay, great. Figured I'd check before I jumped into it. Yeah, thanks again so much for having us tonight. Good evening, everyone. Good to see most of you again. You can maybe start, Brian, on slide 9. As you're getting there, certainly the past year has been unique. Thought I'd give an update of how we performed through 2020, how the fund is positioned going forward. Let's try to be brief and leave some time for questions at the end, but certainly if you have questions I'm going through, feel free to stop me. I think overall we came into 2020 from a relative position of strength. That means allocate to the right sectors. We'll go through all the 4 of those that Paul mentioned in a little bit more detail. Low leverage position, we're at 36% coming into the pandemic. We're at about 39% today. Strong liquidity and well leased from a portfolio perspective. Again, we'll go through each of those property types and give you a little more detail on each of those. But I thought I'd stop here on slide 9 Just briefly to remind everyone on the investment strategy, Paul mentioned kind of the core plus enhanced strategy we're pursuing here. There's kind of two components to that, just as a quick review. First, on asset allocation, we have to have at least 75% of the fund in stabilized, well-leased assets. That gives us up to 25% to do in value add and development. That can be anything from truly ground up development, where you're delivering a vacant building, to any type of property that would have some leasing to do, anywhere from 0 all the way up to below 80%, we would call in that value add bucket. So kind of the gamut of value enhancing type properties. That bucket is where we see the best risk-adjusted returns today, trying to really maximize our use of that kind of up to 25% bucket. So, and the second piece of the strategy is what we call moderate leverage. You can see here we're targeting 35 to 40%. We're at 39% as of the end of the first quarter. It's very accretive to the fund today, low cost of borrowing at 3.1%. That's below our historical average of 44%, so still on the relative conservative side of the range, but certainly aiding returns today. Brian, you can move forward. I'll maybe touch briefly on the investment themes here. I think this is an interesting slide to touch on, because if you think about it from where we were a year ago today, our 2020 investment themes, we were really shifting kind of how we thought about the year. These are bullet points or topics that we get together with our real estate research group multiple times throughout the year and kind of evaluate how do you want to execute this strategy. So you can see here that first bullet point is income and income growth, and focusing on properties where we think we have the ability to grow the income. We came into 2020 with that same kind of approach and quickly transitioned as the COVID-19 pandemic hit to preserving income and trying to keep as many tenants as we could. Did a really nice job of that, keeping the tenants we had, keeping our income. And I'd say we're shifting back now at the start of 2021 to focusing on growing that income again. I've got some more slides we can touch on if you guys have interest to talk about that growth story going forward. But we're very, very well positioned in terms of being able to grow the income in the current portfolio. Second bullet point mentioned already just briefly, really focused on that lease to core or build to core. I'll talk a little bit more about that as we go through kind of each property type, but the theory there is stabilized, well-leased product, especially in the sectors that we like. That's mainly multifamily and industrial, very, very high pricing today. And so to access that product, we'd much rather build it today at lower costs, take some of that leasing risk, and achieve higher returns. So again, mentioned that's where we're seeing the best risk-adjusted returns in that non-core allocation. You can see it's 19% of the portfolio today on the right side of the slide there. And then the last bullet point here is kind of that research-driven positioning. The sectors of the country we like, the property types we like, I mentioned that already. And then as we go through each of the 4 property types, talk about some of the niche sectors within each of them that we like today from an opportunity perspective. So Brian, you can flip to the next slide, just a snapshot of the fund. Won't spend a lot of time here. We did just pass for the first time in the fund's history over the $4 billion GAV mark. Strong occupancy within the portfolio, 51 investments, 123 investors. Maybe in the interest of time, we'll keep moving, Brian. Quick snapshot here of where the properties from the fund are located. And certainly rather won't go through each of these cities, but maybe just from a thematic perspective, I'll point you to the bottom right of the slide, which is really our allocation to the gateway markets relative to our Odyssey benchmark. What you see there is a much lower allocation to those 6 markets. That's New York, Washington, LA, Chicago, San Francisco, and Boston. So those large core markets, again, where we've seen that pricing, especially for stabilized product, really rise. This is a strategy we've been pursuing for even pre-pandemic, and I think our positioning served us really well during the kind of COVID-19 pandemic. So underweighting to those gateway markets, for our perspective, was really born out of a pricing decision and a search for a little more yield in places like Seattle, Denver, kind of those secondary markets, Charlotte, Phoenix. What that became last year was avoiding those major markets that were really severely hit by the COVID-19 pandemic. And so we saw outsized performance by being out of those large gateway markets and achieve some additional yield by being in some of these secondary markets. I can keep moving, Brian. The next 4 slides, maybe where I'll spend the majority of my time, is going through the 4 property types. So these are in order. They're all kind of, each of these slides are laid out the same way. In order of largest allocation to smallest, you'll see our portfolio weighting at the top relative to our NCREIF benchmark. So you can see kind of where we stack up relative to our peer set. So we'll start here in multifamily, a sector we like, certainly today and certainly going forward. We have an overweight position. We've had an overweight position for a number of years now. You can see our strategic range. We want to remain above that benchmark. You can see, or maybe the bullet points there illustrate why we like our multifamily portfolio. It's a nice mix of product types. It's both price point and types of product. 95% is in non-CBD locations. Again, relates to that kind of map I just showed you out of those main gateway markets. Again, we're seeing really most of the supply in the multifamily market, as we remained a little bit isolated from that wave of supply in the luxury CBD marketplace. Mix of garden mid-rise. Over half of our multifamily portfolio is in that kind of garden mid-rise, typically a lower price point. Those held up very well through the COVID-19 pandemic. From a collections perspective, last year, really no issues from a collections perspective in our traditional multifamily. We had basically one asset that had some challenges from a collection perspective. That was one of our student housing assets, of which we have 5 in the portfolio. The one that we had issues with was in Manhattan. Again, I say that was really hard hit by COVID and with shutdowns. That one is a little different than the other 4 student housing properties that we have in the portfolio. That one is directly leased to schools rather than directly leased to individual students. So that one was leased to 3 schools and then a nonprofit that provides housing for university students. 2 of those 4 tenants basically stopped paying rent during the pandemic. And so of all of our entire portfolio, that student housing asset one was the hardest hit from a collections perspective. Outside of that, traditional multifamily held up very well. In fact, our other 4 student housing assets held up quite well from a collections perspective, stayed well leased. Even if students went home, they continued to pay rent at their schools and did online schooling, but the majority of those performed quite well. From an opportunity perspective, we'll remain interested in opportunities across the risk spectrum. Again, if we're going to do stabilized deals, probably avoiding those large major markets where pricing is extremely high right now. We'd rather develop or lease to core, meaning take some leasing risk. So we'll continue to develop multifamily projects. We're certainly a premium there where we can build and stabilize for cheaper than you can buy a stabilized product. A great example of that is the one in the photo here, Alta Claire at the Fells. That's just north of Boston, about 7 or 8 miles. It's in a really nice wooded area, actually in the middle of the Middlesex Fells Reservation. Access to biking trails and a lake. That one actually delivers. It was development that delivered right before the pandemic, and so we had certainly some concerns delivering an empty, multifamily building when people weren't moving around as much, and really all the leasing there was done online. That one's actually turned out to be a great success story. Leased up completely virtually. It's just under 80% leased, still kind of completing its initial lease up, but ahead of pro forma from a timing perspective. Stayed under from a cost perspective. That one's 261 units. We built that property for just over $84 million. We just had an appraisal come in earlier this quarter for $127 million. Again, it's not quite yet stabilized, but building it for $84 million when it's valued at 127 today, a pretty nice strategy. So we'll continue to look for development opportunities really across the country, probably avoiding those major markets where we've seen supply. We probably like the mid price point more than the luxury market where we've seen some softness, but remain interested in the multifamily sector. All right, so I'll flip to the next one. We'll have industrial, another sector we really like as a fund. This has been by far and away the hottest property sector in commercial real estate. We've been fortunate to have an overweighting to this sector really for a number of years. You can see 26% relative to the benchmark of 21%. certainly want to remain overweight to the industrial sector. This has really been one of the big winners through the COVID pandemic. And the more e-commerce has grown, has directly resulted in demand to the industrial sector. So we're seeing really tremendous tenant demand really across most markets. And so our favorite investment strategy today would be to develop industrial product, keeping an eye certainly on supply across the country. But again, by and large, the tenant demand metrics have more than kept up with supply. Again, this is another example where core, well-positioned or well-located, well-leased product is trading above replacement cost. And so again, when we can build it and find a site that we like, one of our favorite strategies today. I think that's it for industrial. I'll move to office. This is the sector where we'll probably spending the most time talking with clients and consultants today of what's happened in the office sector. So first and foremost, I think we came into the pandemic at an underweight position. We've really strategically brought this weighting down over the last 4 or 5 years. At the end of 2016, that portfolio weighting would have been in the low 40s, 41%. So you can say we've strategically brought this allocation down over the last number of years. Want to remain underweight to this segment going forward. I think the performance during the pandemic, retail, which we'll talk about next, was the most impacted. But I think long-term office is the sector that has the most question marks around it. Again, that's what does the future of office space look like? Will we all be working from home forever? We don't think that's the case, but it's certainly going to be a headwind to demand for office space. I think businesses and space users are looking very critically at how much space do we need? What does the future flexibility look like in terms of remote working? I think we've proven it can work. And so as a sector, we think there will be continue to be some headwinds to this segment. So thankful to be underweight to this segment. Think we'll remain underweight. By and large, our offices perform quite well from a collections perspective, high 90s to 100 in the last couple of quarters from a collections perspective. Again, a lot of that's due to the long-term nature of the leases in the office sector. But we think there's, again, some questions about how much office space do tenants need going forward. Doesn't mean there aren't opportunities in office. Some of the niche sectors that we do like within office would be life science and medical office. And those aren't tied directly to economic growth. It's demographic growth and aging population. And so some different drivers. Can't do most of those things, or certainly from a lab perspective, can't do that from home. So insulated to remote work. One example of that is the office picture here on the slide, Base Center. It's in Emeryville, California, just north of Oakland. Really, really hot life science and lab market. This is a 3-building asset. One of our buildings is completely lab space. We're looking at converting a second building from traditional office to lab space. And we actually have some excess entitlements on this site. We're actually potentially looking at building a 4th building that would be lab. Again, the lab market there is extremely hot. The rents are significantly above traditional office. So there are some segments of the office sector that we do like. It's more traditional office that we think will be under pressure really over the short, medium, and potentially the long term. Next slide is retail. Again, probably the hardest hit during the pandemic in terms of shutdowns and foot traffic. Our smallest weighting from the portfolio at 12%, underweight to the negative weighting of 18%. We haven't bought a retail asset since 2016. I don't think we'll change that anytime soon. We're starting to see some repricing in this sector. And so there's potentially will be some interesting opportunities, but not the top of our list today. From a performance perspective, retail has actually, our portfolio performed decently well. Saw collections drop to kind of that 60% range, kind of second quarter, but bounced back pretty nicely. We're back up to high 90s and 100% here as of first quarter 2021. So certainly took our pain from a collections perspective for a quarter or two, but I've been pleasantly surprised with the bounce back there within our retail portfolio. Why is that? I think it's a lot of because of the makeup of our retail portfolio. No mall exposure, We've never owned any enclosed malls in this fund. 67% or 2/3 of our retail portfolio is grocery anchored. Again, if there's one winner from a retail perspective, it was the grocery stores. They saw really record-breaking sales over 2020, helped drive traffic to those centers. Only one power center within our portfolio, that's in Houston. We actually are in talks with a grocery, Whole Foods, to add to that center and potentially turn that from a power center into a grocery anchored center. That would be a huge win for that center down in Houston. We not only, bring a nice, anchor tenant to that deal, but we think we would allow us to increase the rents on the shop space proximate to that location as well. So some green shoots within the retail sector. We've seen some data over the last quarter or two that have said has indicated that foot traffic is really picking up, especially in the south and areas where lockdowns have been lifted. And so we think there's better days ahead in retail, but certainly glad it's the smallest of our sectors from an allocation perspective. Brian, the next slide is our development slide. Maybe touch just briefly on here before I talk about performance and maybe open up to questions. Again, mentioned at the onset of the presentation, really being focused on this development segment of the portfolio. We've got 3 properties still under development today. We've delivered 3 over the last 3 to 5 months. So 3 remaining to finish. You can see the construction completion date over the next year or so. In markets that we like, 2 multifamily, 1 industrial. So again, in sectors that we like. The Spectator deal, just briefly, that's up by the new baseball stadium, the Brave Stadium north of Atlanta. Great location, great retail amenities. That one's on track from a cost perspective. That's a market that's held up quite well around that ballpark area. We think that one will do quite well. They actually just started pre-leasing and did 30 leases in their first month without the project even being done. 3515 Walnut is in Fremont, California. Again, East Bay location that is very underserved from a multifamily perspective. That one's had a little bit of delays in terms of lockdowns and construction, so we're a little bit behind where we thought we'd be from a timing perspective. Cost perspective, we're in line with kind of what we had underwritten. And from a rental perspective, that market's held up very well. We're seeing rents kind of above what we had projected when we began that development. And then the last one on the list here is an industrial property in Phoenix. This will be the 3rd phase on land adjacent to 2 projects that we own, phase 1 and 2. 2 successful developments in the Mesa area of Phoenix. Again, so markets we like, properties, sectors we like. This is a portion of the portfolio we think will drive a lot of the appreciation over the next couple of years. And again, we want to continue kind of planting seeds in that development bucket to help some of those yields in the portfolio. Brian, you can turn to the next slide and maybe I'll touch on this one and wrap it up.
Yeah, Brent, we have to start to wrap up and make sure we want to get any questions. Just there's more on the agenda that we have to get to.
Oh, you bet, Brent.
But
I can maybe pause there. The performance maybe speaks for itself, but outperformance across all time periods. Really strong first quarter here in 2021. I think we've turned the corner nicely from a commercial real estate perspective. But yeah, I'll pause there, Brian, and open up for any questions. Make sure I'm.
Yeah, I want to make sure the board has any questions. Yeah.
Yeah, you bet.
Does anyone
like
want to jump in? Go ahead. Tom.
Yeah, it seems like we're good. I think we've kind of covered this in enough depth. And as you say, we've got more on this agenda.
You bet. Well, we can pause there and thank you all for your time and appreciate the support in the business.
Thanks,
Very good.
everyone.
Thank you, Brett.
Thank you. Have a
Thanks,
good night.
Brent. Thanks, Paul, for joining us this evening.
You're welcome. Bye-bye.
See ya.
Okay.
All right.
Next stage, Brian, you believe you're next.
Yeah, so let's bring up the Vanguard presentation. I know we've covered a lot so far, probably, lots more presentations than usual. So it's, you could get me and Brian anytime. So in the true interest of time, we'll keep it high level. I think there's some important results to cover on a year basis or a fiscal year to date basis. So I definitely want to hit performance. And then Brian also prepared some slides as it related to our private equity conversation, just where we are on the pacing. I know we won't get through it all tonight, but this conversation around private equity will continue. But that's the gist of it. And so I was just going to start here on page 4. You can see everything, Tom?
Yes, I can.
Okay. Again, you could slow me down, but I'm going to go on the faster side, just in the interest of time. So what we've seen in the equity markets is just a continuation of that strong performance with all the fiscal support that we're seeing from the government, Fed still keeping rates low, and vaccines, working their way throughout the population. We see U.S. stocks year to date up over 6%, non-U.S. stocks still trailing, but up over 3.5%. Fixed income has been the loser. So, and that, that's been one of the weakest quarters on record for the fixed income markets due to the rise in interest rates, or I should say, not the interest rates, but the 10-year yields moving, kind of anticipation of seeing some inflation and more growth. So U.S. bonds down over 3%, and non-U.S. bonds not as bad, but still down 2%. So bonds did provide their role in the portfolio last year and providing that protection that we saw a year ago when the markets were plummeting. But as we've seen some interest rate rises in the 10-year yields, we've seen weaker performance. So that I want to bring us right to the performance of the portfolio. And on the 3-month, just summarizing from what the equity and fixed income markets did, we're up over 3% on the 3-month basis. As we start to go out longer term, the numbers get even more eye-popping. So on a fiscal year to date, we're up over 18%, extremely strong returns. And then 1 year, which is really the 1 year that we've been with the town of Fairfield. So it's hard to imagine that it has already been a year. We've accomplished a lot. But on a 1-year basis, the portfolio is up over 29%, slightly above its composite benchmark. So very strong returns across the portfolio. If I gave you some perspective, so this market value as of the end of March was 447 million. I looked at where we were a year ago. So at the end of March last year, the portfolio was only at 350 million. So we're talking about a difference of about $100 million. So it's quite astounding. As far as the portfolio allocation, that we monitor these on a regular basis to stay within a target at the asset class level, equities, fixed income, real estate, and private equity. As always hit on, we always have some cash above the target. We raise that at the very end of the month for pension payments to go out the first of the month. So again, in summary of the returns, we've done a lot with the portfolio in this past year. I think there's been some benefits to the asset allocation changes, in the sense of eliminating that dedicated cash sleeve that was 2% of the portfolio, commodities, which was 3%, even hedge funds were 10%. So I think that it's given the portfolio the ability in the up markets to capture that performance, but we still have 35% to risk reducing assets or fixed income to protect in the down markets. So I think we have a very nice asset allocation that's helped contribute to that absolute returns. And just as looking out 10 years, so looking out 10 years, the portfolio's achieved over 7%. That's the return target in the portfolio. We'll come to this maybe in future meetings, but certainly think it's going to be harder to hit 7% over the next 10 years and even 30 years, given the gains that we've seen in the equity markets, especially the last 10 years. When I flip the page and start to look into the performance at the other, all the asset classes or sub-asset classes, I won't touch on the public equity or public investments part of the portfolio, just hit a little bit on the private equity. So for the 3-month, and recall this is lagged a quarter, takes a while to get those valuations. So this is really looking at the fourth quarter returns for the private equity. We finally saw some of those marks, get increased. So from a relative perspective, the private equity was at during the quarter was outperforming its benchmark. On a fiscal year to date, it's lagging, but it's important to look through that. And both of the managers, Mesereau and Lexington, hit on this. Is these funds are in different life cycles, or as far as how much they've committed or returned. So you can't necessarily compare one of these funds to each of them. But as you could see on a fiscal year to date or 1 year basis, we've certainly recognized some very strong returns from the private equity investments. And then lastly, on the the private real estate, which we were just covering with Principal, if I, on the quarter, or this is the fourth quarter now, they did outperform in the fourth quarter, 2.02 versus 1.29%. On a 1 year basis, they did lag, and that was really because of fees. On a gross basis, they outperformed, but after you account for their fees, it was 80 basis points versus 1.1 for the Odyssey Index. But as Brent mentioned, 3 years, 5 years, the Principal Fund has outperformed its benchmark. Jumping to the OPEB portfolio, as far as the allocation, you'll recall that it's slightly more aggressive here in the sense that there's more in equities. It's a 70% towards equities and 30% to fixed income and real estate. So on a 1 year return, that explains why we're at 40%. Recall the pension was up 29%, so amazing 40% return in the OPEB plan. And as it relates to the asset allocation, this is here in March, but I just want to let the committee know that in April, on April 19th to be specific, in the employee OPEB plan, we did rebalance the targets because that got over to 75% equities. So we rebalanced the employee plan. The fire and police plan is very close to that threshold. So I wouldn't be surprised if the markets keep moving that we'll do a rebalance back to the policy targets on here on page 10 in the fire and police plan. Yeah, and this portfolio was down to 46 million about a year ago. So that's a quick recap on performance. Was there any questions, or did I gloss through anything too fast from the commissioner standpoint?
Good here.
Okay.
Hi guys, I'm back. I've made it back.
Hey, Carolyn.
You guys did a great job. Brian, this is great performance. This is a fun one to look at.
Yeah, no, it's
It's an easy story to tell.
That's right. And again, so of course you can't take credit for the market, but I think as I hit on, some of the allocation decisions did help in the last year.
Yep.
I'm here on page 15. I'll let Brian jump in, Brian Scott, because we just wanted to show some cash flow modeling that just takes the entire private equity portfolio into consideration. And this is assuming no new investments. We could talk about future investments at the next committee meeting, but let me hand it off to you, Brian.
Thanks, Brian. Good evening, everyone. In the past few weeks, we've been working with Mesereau and Lexington, preparing for tonight's meeting. And with that, they were able to provide us all of the cash flows for the the 3 Lexington funds and the 2 Mesero funds going back to inception. So that's what we're seeing here. The chart up on the top half of the screen, the solid bars are the distributions out of the fund, and the pattern or shaded color bars are the capital calls. And then the table below shows the net cash flows for each of the funds. Just wanted to call out 2 of the funds in particular, the Lexington 3 Fund and Mesero 6. These are the 2 largest positions from a market value. About 80% of the PE program is comprised of these 2 funds. And then from a capital call standpoint, about 70%, capital commitment, about 70% is made up from these 2 funds. And if we go out through 2018 and 2019, we start seeing the J curve for these 2 funds start to slope upward. And in 2019, you can see positive cash flows for 1.6 million for Lexington 3, and then Mesero 6 about 0.4 million. And we expect that to continue going forward, especially what we heard tonight. We think it's going to pick up. And if you look at 2021, that's year to date through March, we've seen positive flows of 2.1 being distributed from the various PE funds, primarily from Mesero 6. On that note, Mesero just sent us an additional $300,000 today. So this number is really, from a net cash flows, is 2.4 million now. So if we annualize that out, we're approaching about 9 million on a year-to-date basis. So we're going to be almost net cash flow positive from a PE program standpoint. And if we go to the next slide, if you don't mind, Brian, this is our forecast going out 10 years for the PE program. The green bars are the legacy distributions from the 5 funds, and the blue bars are what we anticipate from a capital call standpoint. So we're expecting about 10 million this year in distributions and just shy of 4 million in capital calls. And then that capital calls really tapers off in 22, 23, and years following. So with that in mind, just the next slide here that we have is from a target allocation standpoint. We anticipate that the target allocation of 5% will breach in 2022 due to the distributions out of the various funds, primarily Mesero 6 and Lexington 3. The green dotted bar, or green dotted line that you're seeing there, that's assuming the assets in the portfolio grows at 2% per year, so very conservative estimate there. So if we were a little more aggressive, we would potentially be under the target allocation a little bit sooner. So just wanted to bring that to the committee's attention. I know there's plans to talk about PE in the future, but just wanted to show you some of the analysis we performed in conjunction with Mesero and Lexington. Any questions on the last 3 slides?
Does that help, just considering the PE allocation? Because if you go to the slides in the beginning, we're overweight our allocation right now, but that will kind of like from a Glacier perspective, it'll start to change even throughout this year as the funds are more mature. So we're going to be getting more from these funds than we are getting through capital calls. So I think that, that's what we just wanted to provide as a static look as we consider future allocations to private equity in, perhaps later this year.
I would love to see us. I would love to see us continue to invest in private equity. I think a primary fund option might not work given kind of the age of our funds and the fact that a bunch of them will be running out. I thought the direct investment ones were interesting, and of course secondaries have a much shorter duration and life cycle. So that's probably where we'd want to be focusing. Love to hear the thoughts of other folks, especially after tonight's presentations.
I thought the funds were very diversified, like the private equity funds, right? We had one that was the middle market, the secondary middle market, but when you went to, I guess, Mesro, you saw that they were in buyouts, they were in venture capital, technology, so they were across the board, very well diversified within the private equity sector, and you saw like the returns that they're producing from this segment of the market.
I got goosebumps.
And it's hard to tell. It's hard to tell on a monthly basis, right? Because we're looking at on the performance, right? We're going against, public markets plus the 3%, and these things aren't lying to each other, right? Because in the early days, there's not going to be good returns because you're first making the investments, and as they make the investments, and some of them are very early successes, but over time, they're building a portfolio, and you don't necessarily get the big value transaction until you really exit the transaction, whether they go an IPO, they sold to a strategic, or some other exit strategy where they're going to get the money back, and very high multiples.
Yeah, and that's what's referred to, and I think you've heard them both say, that's what's referred to as the J curve. You're sending money to these managers, you're not getting any return, so you're flat or even negative until 4 or 5 years later, when they start to distribute those gains from acquisitions, IPOs, selling the companies. So it takes a while, and when we think of the private equity program, that's why we think of it as continually to invest, because there's different vintages. Each year is bringing different investments and different economic scenarios. So it's a continual investment to keep that diversification and to try to keep that allocation constant over time. Very hard to do, but that's the end goal. Carolyn, I wanted to jump on the point, and maybe it's a future discussion with the actuary. I did speak to the actuaries with regards to the pension plan and the employee pension plan specifically, because I believe that is the one that is closed. Fire and police is still open, but if I understand my conversation correct with Hooker and Holcomb, is it's closed, but they're still accruing benefits, and so therefore, the life of the fund, even the employee plan, is going to go out. I mean, I want to work with them more to get some cash flows, but I think the life of the fund is going to be easily more than 20 years, even though it's closed, because you have active employees, got in before it closed, that, still might have 20, 30 years, yet to live. So the assets will be around for quite some time.
Yeah, I think we need to understand that a lot better. But I also don't think we necessarily have to invest pari passu the town funds and the police and fire funds. I mean, it might be subject to further discussion, but police and fire continues on, may want to continue with a private equity program, irrespective of kind of the considerations for the town side, because those funds were closed to new participants a few years ago.
I think that's an important conversation, and one we had a little bit with Jared and Caitlin last year, because right now, as far as on the pension side, all of the assets are together in one portfolio. And I think they're accounted for separately, of course, but we could look about splitting those into two separate portfolios. Let me step back. There are two separate portfolios, but all of the investments are with what's referred to the funds account. So there is an employee plan, there is a fire and police plan, but they're not holding the investments. This funds account is holding all the investments. So there may be I'm sure there'll be some work in trying to separate those out, but I do think that's definitely a discussion for this year, and that could impact in how we think about the asset allocation for the fire and police, perhaps different than the employee plan. On the OPEB plan, there are two separate accounts, and their investments are held uniquely in those accounts. There's not one aggregator.
Well, I might I might suggest that we kind of table this until next month, right? We've heard a lot of information.
Yep.
Our jaws have dropped to the floor with some of the performance numbers we've seen here. And we really have to give hats off and, a compliment to our predecessors on these boards, for selecting those investments in the first place. Kudos to them. So why don't we kind of come back to this? Let's sit on it, think on it. There are a couple ways to approach it. I'd love to understand first kind of everyone's temperament and kind of, appetite for continuing on in a private equity plan. And then secondly, if the two boards want to go kind of a slightly separate path, we can entertain that and talk about it. But thirdly, and most importantly, I think we really need to understand the math within the town plan, and when the cash flow becomes more of a concern for us, that it becomes more challenging to reach for a private equity program. That makes sense?
Yeah.
Great.
All right.
Well, good. Yeah, I'll pause there. I agree that there's a lot discussed, all good. And I'll stay on the line in case there are other questions, but I know there's some more business.
Tom, it is still your meeting. Thank you for running this for me with my little crisis of the evening.
That's okay. We're nearing an end. So CFO report, and I see Jared on the call. I thought I saw Jared.
I'm here.
He's there.
Here, I didn't send you guys this report, so I'm going to share it. There's not a lot to share, so it should be a very quick report. As Brian mentioned, we have just to remind everybody, we have the funds account, and you see if everybody can see this, the internal transfers at the end of March that went into the respective from the fund number 20 into the fire and police and town funds, so that they could be paid out to the retirees, which happened on April 1st, first of the month, as they do. And so you see there was sufficient funding there to be sure that they got paid.
Very good.
Short and sweet.
All right. Well, moving on, old business. Actuarial services RFP. We're down to a short list.
So special meeting, guys. You saw the notice. Special meeting is next week, Tuesday night, 7 p.m. We're going to do it by WebEx. The town has not green-lighted in-person meetings yet. And so we have been instructed that this meeting will be done via WebEx. Please, if you would, we're going to have 3 finalists. We started with 11 respondents. We whittled it down to 3. You'll hear presentations from all 3. The hope and plan is that we will be able to take a vote on it that evening. That's what the agenda says. If something comes up along the way and we're not able to, that's all right. We'll call another special meeting 5 days later, and we will vote then once we've gotten the information. So we're trying to move this along. Please make an effort to be there, because this is one of the important ones, the important decisions we make as a board.
Carolyn, just a quick question for the members that are not on this subcommittee. What are the finalists? Who are the finalists?
Sorry, I should have told you that. It's been whittled. The finals have been noted. We can explain that now, Jared, right? They've been notified.
Yes, I believe. Yeah, I think that's okay.
We have not notified those who haven't been selected. I don't know if we have to wait for that.
Okay, that's fine. That's fine. You don't have to bring it up. That's fine.
Yeah, we've got issues with the RFP situation. You will you'll certainly receive information on that before the meeting, and you'll get their presentations to review. The skew, I can give you some flavor. The two things that really stood out the most that we skewed for, and Kevin, Eric, Tom, jump in if I'm speaking out of turn here, was kind of their ability. Everybody had a strong financial position. Everyone who responded was a serious player in the industry, and a subject matter expert. What we found to be points of difference that were relevant to us as the group was their ability to attend our meetings, so proximity to us. Do they have experience in Connecticut? Do they have a home office nearby? That was one thing. And another thing was the substance in the report that they deliver to the pension boards. Kind of what insight are you bestowing upon your pension board besides the rows and columns of the numbers? And there was a pretty good dispersion among them on that ground. I don't know if anyone else would like to jump in.
Yeah, I would make one comment that one thing that impressed me that all the members independently seem to arrive at the same conclusions without talking to one another. Just looking at it objectively, there was quite a consensus, if you will, as who's number one, who's number two, who's number three. So I felt that was encouraging. That without huddling up, each individually, I saw the conclusion arrived at.
Just one question. I don't know if it was part of the RFP or not, but when we do get the names of the finalists, if we can get who their clients may be, so we could reach out to the other pension trustees and find out what their experience is with them, that may be helpful, at least for me.
Eric, I'm really happy to say that was an important piece of the RFP, and that each of those that were selected as finalists have a pretty good history and were really forthcoming with the towns and the contact people and how long they've worked with them. I mean, that level of transparency, you'll see it. These things are binders. Each one's about, a couple inches thick.
Well, then, the second half of old business, pen checks. Carolyn, do you want to speak to that?
I'm going to hot potato that one over to Jared. Are you there, Jared? Are you able to unmute? He's coming.
Okay, can you hear me?
Yep.
Yeah, now.
All right. My unmute button was off my screen for some reason. So we had a last minute change that we had to deal with, or that we chose to deal with in the way that we did. When it came down to us that Peoples was going to stop doing the pension payments, the actual payments to the pensioners, we started pursuing other options. And the one that made most sense was to go with Penchecks, who they had formed a relationship with. Really, in the 11th hour, we had signed an agreement with Penchecks, and we're ready. It was a Friday, and on the next Monday, we were going to start the process of working with them, giving them data, sharing our data with them. We got word from People's M&T that M&T was going to continue to provide the service. So at that point, it didn't make sense for us to make the switch to Penchecks. And so People's/M&T will continue to do the pension payments for us until we get another opportunity to take a look at that service again and go out and see if we're getting the best deal and if we're getting the best service. So it's status quo is the short answer.
If you guys recall, we had a really short window that they were going to terminate the service, and we had made kind of the decision that we would move temporarily to Penchecks right? It was not going to be a permanent home. It would be a temporary hub. And then we would commence with an RFP to do a full search. So this allowed the temporary hop to not happen. But once we're through with the RFP for the actuary, we'll go out and search as planned.
All right.
Okay.
The only reason that they decided to continue this line of business is related to that merger then, right? Because prior to this, Peoples was not planning on merging. Well, it wasn't public news. They announced a merger after the fact, and like you said, the last minute, they say, oh, by the way, we're keeping the business, and raises some questions. So I think we definitely need to go for an RFP, and once again, see what's out there. We gain the best thing. Forward to that.
Well, if that concludes our old business, we'll ask if there's any new business to be discussed.
I know it's a long night. I only have one quick new business item. One of my union members was doing some investigative work and found that our pension trusts, both the police, fire, and the town, are not set up under a 414H provision under the tax code. Now, what does that mean to the trust? Nothing. What does it mean to the employees? Is that our contributions are not tax deferred. So we're paying our contributions into the pension fund post-tax. My back of the envelope calculation is if we were to adopt this 414H pickup provision, it would save the police fire employees approximately $200,000 and the town employees about $260,000 in income taxes. It's my understanding that it wouldn't take much more than maybe a vote from the committees to adopt this provision. It would basically be, instead of the employee contributing out of the paycheck, which we would still do, it would be the town would be picking up the contribution and making the contribution directly to the trust. There'd be no difference to the trust. It wouldn't see any difference in income. But from a tax deferral standpoint for the employees, it would be significant on our W-2s. So I guess what I'm asking from the pension board, I really don't know enough about it. I think at this point, we really need to seek legal counsel. So basically what I'm asking for is if anybody wants to help me on this as a subcommittee, you don't have to volunteer now. Like they always say, don't volunteer for anything. But if anybody wants to shoot me an email and help out, I think that the tax savings to the town employees is too significant to not investigate, especially if it's a no-cost item. I don't know if Brian or Vanguard may have a more insight on this, but I was very surprised that most of the pension funds, whether it's the New York City firefighters or whether it's our state's own pension funds that are open for municipal employees, do have this 414H provision, which has a tax deferral.
Can I just interrupt? This is Chris, your recording secretary. The town employees are paying on a pre-tax contribution. It's only police and fire that are post-tax.
Yeah.
That changed quite a few years ago for the employees.
Thank you very much, Chris. You don't happen to know how that went into effect, do you?
I don't know. I'm going to say it's around 2005 it changed. I'd have to look into it, but I do know that we are taking employees' contributions pre-tax.
Chris, thank you very much for that information. I didn't have that, and that's very important. Thank you very much.
No problem. Thanks, Eric.
It sounds like you're halfway there. Yes, sir.
I was going to say, Eric, Chris kind of didn't steal my thunder, but I'll happy volunteer. But, on the unaffiliated on the board side, I don't know how would we even, since it might be moot, but we're not a union. So how would we vote, and what would we need to poll all the members of the current pension if we were to make a change? And it's just interesting on how we're represented as a group, and I actually spoke at the beginning of the meeting. I was wondering if I could even get a list of our active members in the pension so I could at least communicate with them on the board side.
Yeah, that's a good point. I don't know. All I can say to it is that it seems like the tax code part just takes an action by the fund itself, whether it would reside in the JRIB or whether it resides solely in the Police Fire Pension Trust. I would have to look back and find out how the town employees became that tax deferral and investigate.
I think that's an important point that, we have to do a post-mortem on what occurred to make that transition, so we fully understand, that there's no landmines here we could step on. Yeah, Jared?
Yeah, I think we'd all benefit from hearing, to your point, Tom, I'm not sure who it would be or which people it would be, but to know the background of this, how it happened, whether it was intentional. There are I think there are a lot of ramifications to this potentially. I think it would be great if we scheduled something at a future meeting for, figure out who it is we need to have in here to give us the history and the background on it, and for everybody to hear about it.
Yeah, so I'm currently already trying to find out, a pension law firm that could possibly help us with this. I don't know if maybe Eric Newman's got someone they can recommend out of Stanford, but someone to kind of look into the tax code side of it, that would be helpful.
Yeah, I'll talk afterwards. And
So why don't we make a point of putting this on the agenda for next month, right? And just see what, and have somebody kind of give us that perspective and that color and, the background that we need, and what's involved, just so we understand it better. And let's see what we can do.
Chris, do you know exactly what year this transition took place? I think I heard 2005.
I think it was 2005, but the only question that I would have to look into is, I don't know if this is purvey of the Joint Investment Retirement Board or if it's the actual employee and police and fire boards that would have to look into it. But I'm still in the office for a few more days, so I can look into to see when this was done, and we might have some background on what firm we used when we went that way. But I'm in the office the next couple of days, so I can see if there's any background on that and get it to you guys.
That'd be great.
Okay.
All right then. Any new business? Right. I'm sorry. Any other new business? Seeing none. Do I have a motion to adjourn?
I'll make the motion to adjourn. Thank you,
Do I
guys.
have a second? Eric?
Caliper, second. Thank you.
Okay. All in favor?
Aye.
Aye.
Thanks, everybody.
Thank you, everybody.
Great.
Bye.
Good night, guys.
Night, guys.
Thanks, everyone.
Bye.